Welcome back. You've joined us on Markets at Noon right here on ET Now, and let's try to understand what the fundamental setup of the market is looking like. And to understand exactly that, we now have Mr. Nilesh Shetty, Portfolio Manager at Quantum Advisors, now joining us. Mr. Shetty, afternoon, and you've joined us on a historic day, on a day where Nifty hit an all-time high, Sensex too, and so is the case with Bank Nifty. What do you make of the market at this point in time? I believe most of the headwinds, most of the uncertainty is largely behind us. Which triggers will ensure that market continues to scale fresh all-time highs going forward in the next 2 to 3 months?
Yeah, I mean, the markets essentially are following earnings. Assumption is that H2 will be a lot better. India went through an earnings cut over the last few quarters, and commentary from managements, especially after the festive season and with the GST cut, suggests that a lot of the earnings negative surprises is over, and you should expect either the earnings growth to stabilize or you might have some upgrades coming through, which is what the market is reacting to. And of course, with the time correction that happened, valuations became a lot more comfortable. So at least where we stand today, we think the market is very well positioned. When we look at bottom up in the portfolio that we have, we think there's this decent upside over the next 2 years. The big trigger will be this India and US tariff deal whenever it happens. I think that'll be a positive catalyst for the market. And then, of course, you'll have the budget coming through and what expectations are built into the budget in terms of government spend. But generally, when you look at bottom-up setup for the market right now, it looks like we should have a fairly decent run over the next 2 years.
Hi Nilesh, hi, this is Ankita also joining in. Good afternoon to you. So you're saying that there could be a decent room for a going forward. So by the end of this year, towards the end, we are coming towards, we're entering the holiday period. Do you see a Santa rally on the anvil, perhaps?
Yeah, we are slightly longer term investors. So I don't have a clue if there is a Santa rally or no. But there are enough elements, including slightly better valuations, better demand growth on the anvil, sort of catalyst in terms of macro, which should take the markets higher. Whether it happens in sort of December or Jan, I don't know. But if you're a slightly longer term investor with a 1-2 year horizon, with the better monsoons, with the GST cut, with a potential deal somewhere around the corner for India and US, you have enough catalyst for the markets to move higher.
Okay, and from a valuation standpoint, Mr. Shetty, how do you view India at this point in time? Do you believe relative to long-term average, India perhaps is attractively priced at this point in time?
It is not attractive, but it is not, especially larger caps, it is not extremely expensive as well. And there are large pockets like banking, IT services, where valuations are far below their long-term averages. So it is still a stock-specific market where you have to be careful in terms of what stocks you want to add to the portfolio. But there are enough opportunities coming through for you to build a decent portfolio that should give you a decent upside over the next 2 years. Again, at least when we look at our portfolio, we have a large weight in banking, we have a large weight in insurance, we have a large weight in IT services, where we think valuations are far below their historical averages.
Right. Nilesh, let me come to the classic discussion of value versus growth, because you mentioned value so many times, the fact that you're seeing valuation comfort in the banking names, in the IT names. But what about other sectors where you do see growth in the next 2 to 3 years, and also within the banking pack? What's giving you more comfort, the private sector banks or the public sector banks? Because the PSUs are now playing catch up, but there is still sort of a margin pressure looming on the private sector banks.
I mean, our sense is India will continue to hover around that 6.5% GDP growth with a 4-5% inflation, which puts that nominal revenue growth for most companies in that 12 to 13% range. I think most companies will track that. I don't think I doubt any sector will be a big outlier to that number. But valuations in different pockets are very different. Some pockets like consumer staples still are extremely expensive, but valuations in private sector banks are a lot more attractive. So even within banks, we have a large allocation to private sector banks. Again, IT services is more a global growth story. And if US discretionary spends come through, and if India-US deal gets through, again, you will see a sentiment change there, and you will see a re-rating in that bucket. So it's not that earnings growth we expect to be any different. We expect it to hover around that 12 to 15% number. It's just that certain sectors are much better placed in terms of valuations versus other sectors.
Okay, so that's as far as your individual sector specific ideas are concerned, but any sector you are probably staying away from at this point in time, either from a valuation standpoint, or you believe that earnings growth is not likely to be as positive or as strong as compared to other sectors?
Yeah, at least the big euphoria is in the industrial space. We think that sector is reflecting the kind of fraud that we saw in that 2003 to 2007 upcycle. And the actual numbers are nowhere close to those numbers. So I think, again, they've seen some correction, but valuations still are extremely expensive in that bucket. Consumer staples have gone through some time and price correction. But again, it's still quite expensive. I think they may continue to underperform over the next 2-3 years if we have a broad-based economic recovery. There's no reason to pay 60 times earnings for a company which are growing at 10 to 12% when the rest of the market is also giving you the same kind of growth but priced a lot lower. So our sense is these two sectors may continue to underperform, and which is where we have zero allocation at the moment.
Nilesh, how do you see the discretionary end of consumption? Given the fact that we have had a GST rate rationalization, we also have a rate cut on the annual. How does the discretionary end then look like to you?
Yeah, so we have an allocation to the automobile space. We have allocation to financial space who are linked to sort of consumption growth, but we don't have allocation to consumer staples per se, where we think valuations, even after corrections, still remain expensive. So the consumer discretionary growth we are playing through primarily automobiles in the portfolio.
Understood. And any other sector-specific calls, especially on IT? What's your view over there?
Yeah, there is a lot of pessimism about AI and H-1B visa costs, but our sense is a lot of that is already in the valuations. I think if you're a slightly patient investor, given the way rupee has moved, which again is a tailwind for these companies, we think where valuations are right now, there is a limited downside risk. But if things were to turn a bit more positive, you will see a decent rally in these stocks. So we remain positive, and we've continued to add the last few months in the sector.
Right. Nilesh, you mentioned at the start that you're incrementally positive as far as the domestic story is concerned, but FII selling has been a consistent problem because they have been selling incessantly, and right now whatever buying that is happening is perhaps the short covering that is happening as far as the FIIs are concerned. Do you see the FIIs return to India anytime soon? Because as far as the domestic story is concerned, India is ripe for an up move. In fact, the second half, we are also expecting an earnings growth coming in. So how is India stacked up as opposed to its peers in the emerging markets?
Yeah, a lot of the selling was driven by the fact that flows into emerging markets primarily come from GEM portfolios, and they were significantly underweight China. And once China rebounded, they realized they had to reallocate their portfolio, and most of them were overweight India at that point in time, and India was getting expensive for in terms of valuations. So that reallocation trade is what triggered outflows from India and inflows into China. But there has already been a significant rally in China, and you might not see that kind of outflows from India and inflows into China anymore. But there are this long-term stable pools of capital, primarily from pensions and sovereign funds, which continue to allocate. If they see opportunities for India, they will continue to allocate in India. And our general sense is most investors, relative to what weight India should be in their portfolio, they are underweight. And that anomaly has to correct over the next 5-10 years. So India will continue to draw significant flows. There could be temporary aberrations like you saw in the last 12 months.
Okay, so when that's the view when it comes to India's fundamentals and how India is positioned as compared to the rest of the world. Mr. Shetty, thank you so much for taking your time out and joining us here on ET Now and helping us understand what the fundamental market setup is looking like. Thanks so much for joining us today. On that note, we need to slip into a very short break, but more news and updates will continue on the other side. Don't go anywhere.